It is time for Mike on the Money. Mike Giordano, financial advisor with Williams Wealth Management. Always love having you here. And kind of back to a topic that we keep landing on because inflation just stays in the news. So a report out this morning shows that inflation seems to be cooling a bit. Is there a good news, bad news here?
Yeah, this was very much a mixed report. The good news is the overall number, which the public likes to focus on, it's come down. It came down another full percentage point to 5% for the last month. That was good. The other good part was some of the things that we can't get away from, housing and groceries at the grocery store. Those things have also come down. So that's extremely important. You can decide that you're not going to go out to eat, but it's unless you're a farmer and you're cooking all of you're producing all your own food, you got to go to the grocery store. And so those things are good. On the negative side, the core metric the policymakers like to look at, the Fed likes to look at, that remained sticky, and it actually went up a little bit in the last month.
Okay, so it's come down from 9% to about 5%. I know the Fed's looking at a 2% goal,
right,
which we've kind of discussed. You've said maybe that's not so realistic, but you can tell the Fed chairman that. Do you think they're going to keep inching it up? Or do you think that next time they meet in early May, they'll leave it alone for a little bit?
They're probably very close to finishing their rate hikes, but the markets are expecting them to probably make one more hike here. The hard part is that they don't have inflation, especially the core parts, the less volatile parts haven't come down enough for them to quit hiking rates, and so they're probably going to go one more. But they should settle out here and pause and just survey the landscape and see where we are. So the good thing is, if you're out there going to buy a home or you're buying a car, rates shouldn't really sneak too much higher, at least in the short term, unless we get some sort of some major headline event. On the other side, though, the market's been waiting for the Fed to cut rates later this year, and unless we get some major event that really hurts the economy, that doesn't seem plausible anytime soon.
A cut anyway.
No.
Yeah. Okay, so there's got to be, I know that you sit down with clients and you help them figure out the dynamics of all of this. Help the viewers figure out, are there some bright spots in here somehow that we can navigate to our advantage?
Exactly. Well, when inflation first got going, right, we got up to about 9%, and savings rates were still really, really low. You put your money in a savings account, you're getting less than 1% interest. Those haven't really come up all that much. However, money market funds have come up with those Fed rate hikes. So as inflation's come down and the Fed's hiking rates more, they've almost offset each other. So if you have a bunch of excess cash, that's money that you can move into a government money market fund, and you can generate more than 4% interest on that. So the money that you need to pay those bills, your monthly credit card bill, all that stuff needs to stay in checking and savings accounts. But any kind of excess cash you could put into money market accounts, and that will at least offset the inflation. So
how easy is it to get it out of a money market account? Is it still considered pretty liquid if it's in there?
Yeah, those are very ultra short-term treasury bills, and so you can pull that money out. It's just not conceivable if you're trying to use it for daily purchases.
Right.
So you want to have that money separated into a checking account, but the rest of it you can get in the money market.
Let your money make some money.
There you go.
Mike Giordano, thank you so much.